Welcome to This Explainer. Okay, if you're starting with zero savings right now and you've ever just stared at your bank account feeling like $1 million is some impossible sci-fi fantasy, well, I've got a seriously mind-bending mathematical reality for you. Hitting your first $100,000 absolutely does not mean you're just 1/10 of the way to a million. No way. Because of the way money actually grows, hitting that first 100K means the millionaire finish line is surprisingly close. In fact, you're actually already a third of the way there in terms of time and effort. Let's dive in. So, here's our roadmap for today. First, we'll look at the linear wealth illusion. 2, the first $100,000. 3, the compound interest snowball. 4, finding your investment cash. And finally, number 5, boring investments and patience. But hey, before we even get into the numbers, let's just acknowledge a very real, very common frustration. Have you ever stared at a tiny investment balance after months or maybe even years of grinding away and thought, man, at this rate, I am never going to hit $1 million? It's an overwhelmingly heavy feeling, right? A few $1,000s saved feels, well, light years away from $1 million. And honestly, that painfully slow start is exactly why so many people just give up before they even give their wealth a chance to grow. Okay, part 1, the linear wealth illusion. Why our brains get the math wrong. To really understand how wealth building works, we first have to completely dismantle a toxic myth that derails most savers right out of the gate. See, our brains naturally want to view wealth building as the simple linear process. We think about the linear expectation and it seems totally logical, right? Like if you save $10,000, you are exactly $10,000 closer. Save $50,000, you're $50,000 closer. But actually, scratch that, it is dead wrong. Wealth building isn't the straight, exhausting line where you have to do literally all the work yourself. It's actually an exponential reality. When you invest properly, your money doesn't just sit there gathering dust. It earns returns. And then, here's the kicker, those returns start earning their own returns. It's this exponential reality where eventually your money starts doing the heavy lifting for you. There's this super famous quote, supposedly from Albert Einstein, that says, compound interest is the 8th wonder of the world. Now, whether he actually said it or not, the core truth there is absolutely bulletproof. Understanding the sheer magic of compound growth is literally the ultimate master key to unlocking serious wealth. Those who get it, build wealth. Those who don't, well, they usually spend their lives wondering why they're stuck in a stressful paycheck-to-paycheck cycle. Moving on to part 2, the first $100,000, building the foundation. Let's break down the exact totally achievable numbers you actually need to reach this monumental milestone, starting from absolute scratch. We're going to build this entire strategy around one simple, highly achievable number, $100. Imagine investing just $100 every single week. That's roughly $400 a month. Now, for this, we're assuming a pretty conservative 8% annual return on your money, which, by the way, is already adjusted for inflation based on historical stock market performance. So let's break down exactly what happens over the roughly 12 years it takes to hit your first $100,000 using that $100 a week strategy. Of that total, you contributed about $62,000 of your own hard-earned cash, while your investments generated about $38,000 in returns. During this initial 12-year journey, you are absolutely doing the heavy lifting. You're putting in the sweat equity while your compound interest is, kind of still just warming up on the bench. And this is exactly why the legendary investor Charlie Munger famously said, the first $100,000 is the hardest. People see that it takes 12 whole years of strict discipline just to hit 6 figures, and man, they get incredibly discouraged. The returns just don't seem life-changing yet, but what they totally miss is that they've just survived the hardest part of the entire journey. By hitting this specific milestone, they've laid a rock-solid foundation that fundamentally alters the math of their entire financial future. Which brings us to part 3, the compound interest snowball. Momentum takes over. Guys, this is the most exciting part of the explainer. This is where we see the mathematical flow fundamentally shift in your favor, and momentum truly, finally takes over. Just think about the jaw-dropping acceleration here. It took you 12 grueling years to go from zero to your first $100,000. But to get to your next major milestone of $200,000, it only takes an additional 6 years. Yep, the second $100,000 takes literally half the time. This is the exact point where compound interest really begins to flex its muscles, and your money is just quietly working in the background, earning massive returns on your prior returns. And here is the massive punchline of the whole mathematical setup. Once you hit that $200,000 mark at year 18, you're not 1/5 of the way to $1 million. Nope, you're exactly halfway there in terms of time. This proves exactly why hitting your first $100,000 meant you were effectively a third of the way done. The timeline just continually collapses on itself as the snowball gets bigger and faster. Let's track this full timeline out. Year 0, you're starting with nothing. Year 12, you hit $100,000. Year 18, boom, $200,000. If you just keep making those exact same $100 weekly contributions, by year 36, you cross the 7-figure $1 million milestone. It's really like pushing a heavy boulder up a hill for the first decade, but once you reach the very top, that boulder just rolls downhill on its own incredible momentum. So here's the absolutely crucial takeaway. When you cross that $1 million mark, the breakdown of where that money actually came from is staggering. Over those 36 years, you personally contributed only about $187,000, but your total balance is over $1 million. That means an incredible 80% of your total wealth came strictly from compound growth, not your own pocket. At this point, your money is generating roughly $80,000 a year in returns alone, and you didn't even have to lift a finger. Okay, part 4, finding your investment cash, trimming without torture. Look, it's one thing to talk about these soaring numbers, and it's another thing entirely to actually find that extra $100 a week to get started. So let's shift gears to the practical, everyday application of funding your foundation. Finding your investment cash for sure doesn't mean you have to live like a monk or eat ramen for every meal until you're 60. Most people seriously underestimate the amount of money just flowing right through their hands. I mean, the average American spends over $600 a month on food. If you cut that by just 25% through a little simple meal planning, you've saved $150 a month right there. Or think about cars. The average car payment right now is over $700 a month for a hunk of metal that depreciates the exact second you drive it off the lot. If you have that just by buying a reliable used vehicle, you've instantly got more than enough to fully fund your wealth building strategy. It's really all about small, strategic trims, not torture. And that brings us to part 5, boring investments and patience, staying the course. So we've covered the math, we've covered the money. Now we really need to talk about the mindset. This is where we get into execution and why avoiding emotional pitfalls is the true secret sauce to wealth. If you're sitting there wondering what to actually invest in to get these 8% inflation-adjusted returns, the answer is delightfully simple. You absolutely do not need complex, risky trading strategies. You don't need to chase whatever hot cryptocurrency is trending or try to pick individual stocks. For the vast majority of investors, simple, unflashy index funds that passively track the entire stock market are perfectly adequate. You're basically just buying a tiny slice of global human innovation and productivity and then holding onto it for decades. Now, what about market crashes? Because, spoiler alert, they are going to happen. The step-by-step strategy for handling them is super straightforward. First, keep investing your $100 weekly, no matter what the scary news headlines say. Second, reframe those falling prices. Treat them like your favorite groceries going on sale. Your consistent $100 is suddenly buying way more shares at a steep discount. And third, simply wait for the historical market recovery. The people who panic and sell during downturns are literally buying high and selling low. Rational investors, they see crashes as an incredible, rare opportunity to load up on discounted wealth. Honestly, the hardest part of this entire process isn't the math at all. It's conquering our modern culture of instant gratification. We want instant food, instant streaming, instant wealth. But true wealth building demands a totally different relationship with time. Boring consistency beats exciting speculation every single time. While everyone else is frantically chasing trends, successful investors are just quietly, patiently adding to their index funds month after month. And that brings us to our final defining question. The math doesn't lie, folks. Your first $100,000 truly is the hardest, but it mathematically places you a solid 1/3 of the way to $1 million. Time and compound interest will work in your favor, but only if you give them the chance to actually start. So, 36 years from now, will you look back at your accounts and deeply thank yourself for starting today, or will you spend the rest of your life paying the heavy price of procrastination? The math is guaranteed, but the choice? Well, the choice is entirely yours.